Hey everyone, so today we're diving into a really cool article from Investopedia that tackles one of the oldest debates in trading. You know, it's a question that really splits people into two different camps, so let's just get right into it.
I'm sure you've all heard that old saying, the trend is your friend. It's like trading 101, right? But there's also that other really powerful instinct that makes you want to buy at the absolute bottom and sell at the very top. So which one is it? Which philosophy is the right one? That's the fundamental conflict we're going to unpack today.
So it really breaks down into these two main schools of thought. On one side, you have your trend followers. Their game plan is simple. Just ride the wave. If the price is climbing, you buy. If it's falling, you sell. Pretty straightforward. But then you've got the countertrend traders. These are the folks trying to time the market perfectly to, buy the bottom and sell the top. Both sides make a good case, but they seem like they're playing completely different games.
All right, so this is where it gets really interesting. The article we're looking at poses a fascinating question. What if the best strategy isn't about picking a side at all? What if you could actually combine these two seemingly opposite methods? What if you could get the best of both worlds?
The whole strategy really boils down to two key steps. First, you use a classic trend-following method to figure out the market's main direction. Are we in a bigger uptrend or a downtrend? Then, once you've got that, you switch hats and use a countertrend method to find those little temporary dips or pullbacks inside that bigger trend. And that is where you find your potential entry point.
So let's start with part one, spotting that big picture trend. And to do that, we're going to use one of the most tried and true tools in any trader's toolbox, the moving average. Now, for anyone who's kind of new to this, a moving average is really simple. All it does is smooth out all the noisy day-to-day price swings. So instead of getting faked out by all the volatility, it gives you a much cleaner, clearer picture of which way the market is actually heading over time.
Okay, now what's really cool about this approach is that it doesn't just use one moving average, it uses three to get a much stronger signal. For an uptrend, two things have to happen. First, the short-term 10-day average has to be above the 30-day average. That shows us there's recent strength. And second, the current price has to be above the long-term 200-day average. That confirms the major, big-picture trend is up. It's like getting confirmation on multiple levels. And, you guessed it, the exact opposite rules apply for defining a downtrend. All right, so we've got the main trend locked in. Now we need our countertrend tool to help us find a good entry point, that little temporary dip. And for this part of the job, we're going to use something called an oscillator.
An oscillator is just a simple little indicator that's designed to do one thing really well: show us those short-term pullbacks. Its job isn't to tell us where the main trend is going. Nope. Its only job is to signal when prices have taken a little breather, potentially creating a nice buying opportunity inside that bigger trend. Now, don't worry. The math here is super simple. You just take the 3-day moving average and subtract the 10-day moving average from it. But here's the key. When that really short-term average dips below the slightly longer one, the oscillator's value drops below zero. And that dip below zero, that's our signal. That's what tells us, hey, a pullback just happened.
And here we go. This is the moment. This is where we put all the pieces together. We're going to combine our trend following rules with our pullback indicator to create a very specific 4-part signal for a potential trade.
Okay, let's walk through these 4 conditions for a potential buy signal. Steps 1 and 2 are our trend checks. Is the 10-day MA above the 30-day? Check. Is the price above the 200-day? Check. Boom, we're in a solid uptrend. Next, we look at our pullback check. We need to see that yesterday the oscillator was not only negative, but it was also falling. That confirms a dip was underway. And finally, the trigger. Today, the oscillator has turned around and is now higher than it was yesterday. This whole sequence suggests the pullback might be over, and the price could be ready to start climbing again. And that right there perfectly sums up the beauty of this whole idea. By being patient and waiting for that small dip, this method helps ensure that, as the source puts it, the investor will not be purchasing shares at the very peak of the cycle. You're still buying into strength, but you're trying to do it after a little bit of a discount.
Okay, now we got to hit pause for a second because this next part is really, really important. The source is crystal clear about this. What we've just gone over is an example of a concept. It is not, I repeat, not a complete, ready-to-go trading system that's guaranteed to make you money. There's a lot more to it.
A real trading strategy goes way beyond just finding an entry signal. I mean, a responsible trader has to figure all of this stuff out. How big will your position be? How much are you willing to risk on one trade? Where's your stop loss going to be if things go south? And just as important, when are you going to take your profits? And maybe the biggest question of all, have you actually backtested this to see if it even works?
So, the big takeaway here isn't some magic formula. It's the logic behind it all. The idea that there is real, solid merit in combining a trend-following approach with a counter-trend one. It lets you stay on the right side of the market's main push while looking for smarter, maybe less risky, entry points along the way.
And that kind of leaves us with one final thought. We've looked at one specific recipe here, using a few moving averages and a simple oscillator. But there are literally hundreds of indicators out there. So the real question for you to think about is, using this core idea of combining trend and countertrend, how would you go about building and testing your own unique strategy?